All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Market continues to trickle lower here after kind of this morning, this just small morning pop that it had in the first 10 minutes, and we saw kind of a drop and rebound, and it's just kind of been low volume, drifting on lower here. Looks like it has a date with 2820 coming into play here with the S&P futures. But if we back this out to a 5-minute chart, you'll kind of see the perspective of this, right? We have this drop that was Wednesday to Thursday, and then kind of this Thursday rebound, and market's kind of been in this range since. Retested the top side of it this morning, is testing the bottom side of it right now. And, most stocks, they're kind of moving right along with the market, but there are some major exceptions out there today. While the indexes are doing what they're doing, there's a lot of differentiation out there in the market today. Now, I mentioned in my note earlier today that, market was green, but the VIX and bonds, they were both they were both trading higher. Now, we don't see that very often, where you get a market scenario where bonds are higher, okay, which is a flight to safety, and we see bonds, pushing into new highs here, and they still have a long way to go higher to adjust to the Fed. And then we see the VIX, which is the volatility index, also trading higher. And it's not a monster move or anything like that. But, that tells you investors, the market may be green, but they're not convinced of any sort of, bullish resurgence or, bullish, buying to come here. They're still worried about some of the volatility that's out there and, some of the choppy that could be in the markets. So we see that coming in. We see bonds, that big move in bonds. It's really weighed on the financials. And, the financials haven't pulled back like other sectors and other industries. But, they're not going to see, great money come into them when bonds are changing as dramatically as they are right now. If we come into something like a Treasury yield curve, we're going to start to hear a little bit of this, most likely in the weeks to come. But, if we look at just this kind of yield curve that's out there right now, the back end, the 30-year, 2.75, on the front month, 2.37. I mean, there's just very little difference between a 1 month and a 30-year bond. It just, there's not much. If you go to 10-year, we're inverted, right? If you go to the 10-year, the yield is 2.32 on the 10-year, and it's 2.37 on the 1 month. So you get a better rate doing the 1 month than the 10-year. Some economists and analysts, don't call this inverted here yet, but you can see how this back end of the curve has been dropping. The 30-year was 292 back at the beginning of the month. It's now 275. That's a pretty sizable drop. The 10-year was 252. Now it's 232, right? The 20 was 274. Now it's 257. We're just seeing, even the 7-year, 241 down to 222, right? So, the front end of the curve is dropping a little bit, right? It's definitely dropped from what it was at the beginning of the month. But the back end's dropping faster than the front end, and in the middle of this curve, we have a massive inversion where rates are simply cheaper than they are on the front end of the curve. And that's just not a good scenario for banks. And you can look at J.P. Morgan's earnings. We can talk about all the positives in there, but they're not going to stay positive if the trajectory of bonds doesn't change, right? And, when we hear all this talk about, growth and prosperity and economic, all of this, right, you go, okay, let's temper that a little bit with an understanding that, we've never seen a growth and prosperity time period where interest rates are like this, not even with some of the some of the quantitative easing back in 2010, 2011, and 2012. Is this a new normal, right? That's the argument, right? That this is the new normal, that we're going to be with this for for a long time to come. And last week we heard one of the Fed governors even say as much. Basically say, look, Fed is not going to have interest rate policy in their toolbox for much longer, as interest rates are going to kind of go the way that they have in Europe, where they're just going to be low forever, or Japan. And that they're going to have to use quantitative easing measures to tighten and loosen monetary policy here. So it's weighing on the banks, out there in the marketplace right now. Now, a few things I want to go out and take a look at with you here. Before we do the challenge, there's no change here this afternoon. There are just no signals out there. None. And, it's one of those where, man, I sure wish I could make one up and say, hey, let's go get into something and let's go trade it. But there just is not a signal out there right now that is coming in. And it has been a very dry spell here. Since the 17th of May, we've seen two signals come into play. And, could only trade one of those with J&J. And, there's just not been anything else. And if you go look at the watch list, you can kind of see, you just kind of chart, the 60 stocks. You can see most of them just really haven't gone anywhere, right? For example, a Procter & Gamble, right? Which, we got time stopped out of right here. But since then, the stock has hardly moved, right? It's down $1 since that time, and definitely not a trend signal, but it's moved back into consolidation. And that's the way a lot of these names are that are out there. The FedExes of the world and UPSs and the Alcoas, they continue their downward trends that triggered a while back. But, as far as new trend formation, just not a heck of a lot of it, out there in the market right now. So going to go into the close. Challenge is a little bit above $4,000, so we'll take that into cash and go into the close here with that cash and look to react to the next signal. Now, there are a bunch of 3-7 crossovers out there today. I'll show you all of them here. And let's, let me change the chart style here. Yeah, there we go. 3-7 crossovers. So right here with Procter & Gamble, you can see the 3-day moving average is crossing down below the 7. 106.17 is the 3, 106.43 is the 7. So we have a downside 3-7 crossover here coming into play. And that's what's needed for a bear signal, right? But it needs a little bit more than that. It needs more than just that crossover. That's the trigger. But the other elements of, hey, you know what, we have a progressing trend starting to form here, they're not in play. They're just not in play right here. You can see the 39.1 stochastics above 50. It doesn't have to be below 50 to trigger bearish, but we're not going to see a lot of bearish triggers with it above 50. So Procter & Gamble, we have that 3-7 crossover action. We have it on GLD. At the downside 3-7 crossover action. This is one I talked about last week. It had the upside 3-7 crossover, and it didn't trigger, right? Today it has a downside 3-7. It's not triggering. There's too much consolidation risk in it. Altria, this is one where it does have a downside 3-7 trigger. The movement is just too much to say, hey, you know what? This is going to be a nice trend to run with here and to trade. This is very much like a Chipotle Mexican Grill last week where, the magnitude was just too much, right? And so getting into the options, they're too expensive, plus the odds of the trend continuing are not very high. So it just doesn't make for a good challenge trade. So it doesn't trigger there on the, algorithm. Here's Pepsi. It has a downside 3-7 crossover. You'll notice a lot of these are your safety plays. Your Gold, your Altria, your Pepsi, Procter & Gamble, and then good old Raytheon, which I think has a 3-7 crossover almost every day, one way or the other, but, no signal in play here with it. So those are some of the downside signals. We hear a lot of talk about safety. If you go buy safety in this market, you'll be okay. Go buy Procter & Gamble, you'll be okay. Go buy utilities, you'll be okay. A lot of the safety money's coming out today, which is really interesting. We have bonds up, we have the VIX up, we have the market now down, and safety's areas lagging. You just don't see it very often, and I think it just speaks volumes to just some of the confusion that's out there and the fact that nobody really knows the next direction and where things are going to tip, and nobody's making huge bets here, on the next direction. But here you see consumer staples, they've held up. They've held up nicely, and now they're getting, they're getting dropped. We do have some upside 3-7 crossover action that may hold by the end of the day. Microsoft is one of those. It's not going to trigger here bullish. Netflix has the chance of a 3-7 crossover today, but no signal. Visa 3-7 crossover today, but no signal here on that. We see Visa, MasterCard, PayPal, Squarespace, this whole kind of payment processing area, having a pretty good day here today. But just aren't signaling, here this morning, or this afternoon, still a high, not just a small, but a high consolidation risk component here to them. So those are the 3-7 crossovers, but none of them here in a tradable spot or a call position or a put position as they sit right now. Now, a couple questions have come in here today. One is on J&J, and we exited J&J for the challenge this morning. And J&J just had a pretty harsh reversal here since. I was asked why it reversed, and my response to why is it reversed, don't know. More sellers than buyers, right? More sellers than buyers. Yeah, it was upgraded. Yeah, they have a lawsuit kind of going on right now with Oklahoma. Does some of that have to do with it? Maybe. Was there some exhaustion buying this morning on the upgrade? Maybe. But go look at J&J. This is not an unusual candle for the stock. It's not unusual for J&J to have these types of days where it's up early and sells off, or it's down early and gets bought up. It's the way J&J trades. And so to add a meaning to every single wick, on J&J just is fairly nonsensical, and there's nothing obvious that I see. Maybe we can put it to a little bit of a exhaustion upside this morning as we saw some of the high volume come in. Maybe we can say, well, Oklahoma versus Johnson & Johnson, and what's that settlement going to have to be, or how much is J&J going to fight it, and, you could go into all of that, but, it's speculation. It's not been a huge volume sell-off, and it just is what it is, right? There's not always a huge big reason for every single one of these wicks that the stocks have. Okay, I'll come back to J&J here briefly as we talk about time stops, but anyway, it's not J&J in this dip. It's not something I'm looking to buy or anything like that. It's not setting a new signal or anything like that. The 3 is still above the 7, and we see the stochastics 50, stochastics 39, 1 above 50. Those major elements aren't changing here with it. Okay. I was also asked about the airlines and why the airlines are not going up even though oil has been going down. And you can see American Airlines, it's had a really bad month, right? These flying tin cans, they're struggling right now. They are really struggling. We see American, just having a real bad month. And you'll notice as well, here's oil. It's also having a bad month. Okay. Interesting. Because isn't the common knowledge, hey, you know what? Oil goes down, airlines go up. Oil goes up, airline goes down, right? Because oil and jet fuel is such a huge cost for the airlines. So there's this market wisdom out there and it makes logical sense that, hey, when oil prices go down, airlines do better. When oil prices go up, airlines do worse. But when we actually get into the data, we realize that wisdom, or that kind of common sense element, it really doesn't make any sense. It really just makes no sense at all. Let's go take a look at the data. And to take a look at two variables like oil and airlines, we're going to take a look at a correlation. So we're going to go and take a look at the correlation between oil and the airline index, XAL. Okay. Now, when we look at a correlation index, up here at 1 means that they're positively correlated. That when oil goes up, airlines go up. When oil goes down, airlines go down. And when we're down here at -1, it means we're negatively correlated. It means that when oil goes up, airlines go down. And when airlines go up, oil goes down. Now, this is correlation. This is not causation, right? There's a big difference there. We're not saying oil's causing the airlines to move, or airlines are causing oil to move, okay? We're just looking at the true kind of change in these two asset prices as time goes by and seeing, is there any real correlation between them? Does this idea that rising oil equals worse airlines or falling oil equal better airlines doesn't make any sense? Well, here we are over about the last year and a half. You'll notice we're above zero about half the time. We're below zero about half the time. I mean, right here in January, oil and airlines, man, where oil was up, airlines were up. They moved together. Same here in April. Same right now. Oil down, airlines down. It's not as heavy of a correlation right now, but there is a positive correlation to where they're both moving in the same direction. We rewind back here to November, there was a negative correlation. Oil down, airlines up, oil up, airlines down. From just looking over the past year, can we say, well, there is good evidence that when airlines go up, when oil goes up, that airlines are going to go down? Or when oil goes down, airlines are going to go up? No, there's none. Absolutely none. We flow through this correlation up and down and all around. There's no real correlation here. Okay, that's over the past year. Well, this is a long-term thing, right? Okay. Well, let's go to our weekly. Any correlation? Right now, the correlation is 0. Tells you that the price of oil and the price of airline stocks have nothing to do with each other right now. Nothing. Look at the stretches that they're positively correlated, where oil and airlines actually move in the same direction. That's more than half of the time over the last 5 years. More than half of the time, oil and airlines have actually been positively correlated, not negatively correlated. This idea that oil down, airlines up, it's just a wrong notion. It's just incorrect. It's not what we see in the data. While yes, it makes sense and all of that, it's not what is happening out there. Now, why doesn't it happen that way? Well, for a number of reasons. Some of these airlines actually have their own refineries, right? So, they actually get, a benefit with, oil or jet fuel prices, rising from time to time, depending on how they're hedged. And these airlines are oftentimes hedged. And so sometimes, the fall in oil or jet fuel isn't helping them. And sometimes it is. But sometimes it's just an economic thing, right? If oil's going down because there's economic fears, well, you think airlines are going to go up? Well, if there are economic fears, fewer people are going to fly. So airlines are going to go down. And a lot of times that's what we see, that in these positively correlated time periods, they're both reacting to the economy or economic data, not to this kind of notion of oil up, airlines down, or oil down, airlines up, right? And that's just not what we see. Did we see it 20, 30 years ago? Even 15 years ago? Yeah, we saw some correlation between the two, oil and airlines. Has that been the norm over the last 5 years? No, it hasn't. And in fact, we could come in here. We can go back to longer. Let's come back here. You just go 15 years, right? Do we see anything consistent? I mean, the last time we had something consistent was right here in 2007 and 2008 when oil made that major rip higher and airlines got crushed. I mean, that's the last time we really saw any real correlation on the, hey, oil up, airlines down, or oil down, airlines up. Since then, since this time period, more than half of the time, oil and airline stocks have gone the same direction, not counter direction. And so, I just show you this as the data, right? It doesn't mean you can't go out and buy airlines because oil's going down and subscribe to that thesis. I get the thesis. I understand the thesis. I'm just saying the data suggests that the thesis doesn't mean anything, right? That there's something else here. There's something more material here. And, I kind of hinted at what is, more material there, and that's the economics of it, right? When the economics are going down, it's going to hurt airlines. It's going to hurt oil. When the economics are going up, it's going to help airlines. It's going to help oil. And there are times here and there where we see them kind of, oscillate back and forth in their correlations. But that's the that's the reality of what we see with the data. So hopefully that helps. As you kind of go and look at the airlines. Frankly, I just look, if you're going to go buy or sell airlines or play with the airline charts. Who cares about oil? Right? I mean, who cares? It's if oil moves $5 in one day, it's probably going to have an effect that day. But over time, is there really going to be that big of an effect? No. The data suggests otherwise. Right? The data suggests otherwise. All right. Last thing I want to go out and look at here with you is around another question I received here today about time stops. And so going back to the algorithm here. And this morning we jumped out of J&J, had zero to do with anything except for the fact that, hey, you know what? Today was the last day. It had not. We've been 5 days in without it triggering step 1 or 2. And when it comes to the challenge, we're using this ATR method. Okay, there's a video on it. You can access that. But we close a trade on a 1 ATR move from entry, a losing trade, right? What's ATR? That's the average true range of the stock. So in Johnson & Johnson's case, it was like $1.90, somewhere in that area. So at Johnson & Johnson fallen $1.90, $1.95, right? Then have to get out, right? Sell 40% of a profitable trade on a 2 ATR move from entry. So if Johnson & Johnson rallies, $3.90 from its entry price, we take off 40%, reset the stop and the 2 ATRs, and reset it, right? Repeat step 1 or 2 after any profit is taken. But the risk of this is being in a trade infinitely, and when we're trading options, time has a cost. And so there are 2 parameters in here. 3 days without triggering step 1 or 2 equals an exit if the option is currently red. Now, with J&J, I fudged that just a touch that one morning. I talked about why. We had the stock, it was green, it was in our direction. The option price wasn't because we had we had overpaid for the option, right? Because of the time we had bought it. It was overpaying. So it still had the principles associated. And that's where, I talked about I evoked number 10. I can step in under kind of unusual circumstances. But 3 days, why? Why is this important? Well, because if we're sitting in a red trade after 3 days, when you look at the data set, this the 600 trades that were made testing all of this, when you look at the data set, the reality is that if it's not at least moved that direction in 3 days, the possibility or the potential of a reversal risk is tremendously high. It's up in the 80% area. So if the stock has not gone our way in 3 days, the chance for a reversal grows. And you start to get that reversal, what happens to the option value? It gets crushed very, very quickly. We saw this here with JD, right? And it pulled on back, pretty much right after we got out, right? With Procter and Gamble, right? This one, after 3 days, was slightly in the green. It says, hey, the odds are that it's going to continue our way. We're not in that high reversal risk. And so on a green trade, right, we take it 5 days without triggering step or 1 or 2, equal an exit. So we give it an extra 2 days. Now that 2 days is important. That 2 days helps to capture, significantly more of a gain in most cases. Why is it cut off on 5? Why not go 6? Why not go 7? Why not go 8? Well, when we run the data, the 5 day over a long period of time, that just is the best cutoff point for profitability. That's it. It's not looking and trying to top and maximize every single trade. It's looking at a data set of 600 trades and saying, okay, what is the maximum profitability here? Is it 6 days, 7 days, 8 days, 10 days, 4 days, 2 days, 1 day? On green, the maximum profitability has been 5 days. Now, in the test that we did in April, right, we did 3 days, and that was it. We didn't put this 5 day parameter in there. But it's something I talked about. I said when we go live, the green will be a 5 day, right? And it has everything to do with not the individual stock, not the individual trade, not the individual circumstance, but the fact that over time, even on profitable trades, if they haven't hit that average true range, that 2 average true range move in 5 days, the chances severely diminish that it will. And so you exit, move on, wait for the next setup. And that's what's happened with Procter & Gamble. That's what's happened with J&J. Both of these, the exact same thing, right? Procter & Gamble, did we get out at the top? No. J&J, did we get out at the top? No, right? But, ultimately, did they make what they're designed to make? No, not at all. I mean, they didn't move their average true range. They didn't go into these trends. But, imagine if we're still holding Procter & Gamble today, awaiting that, right? The stock price is back to where it was when we entered. What's the option price? I mean, the option price is crushed. We can go look at it real quick. But the option price on Procter & Gamble, we had the 21st of June, 105 calls for 257, right? 21st of June, 105 calls. It's going for $2, right? The 105 calls on Procter & Gamble. See, did I have the right date there? 21st of June. Yeah. So 105 calls, they're going for $2, right? We entered at 257. So the stock price is about the same. 105.60 is where we got in. And right now it's 105.40. But the option price is down 20%, right? That time has a cost, associated there with it. So, that's what the time factor is. It's not to, it is not to try to manipulate any individual trade or speak to any individual trade. It is a methodology to maximize the probability of running with a trend. And that's what these trades are about, is maximizing the probability of running with trend. And if we are in a good position to run with trend, run with it. If we aren't, no. This morning, there just wasn't a decision for me to make, as far as getting out. We hadn't moved to 2 average true ranges. The chances of that trade continuing our way in a strong fashion, just not as high. Could it? Yeah. And you know what? We could see J&J up $7 over the next 3 days, right? That could happen. We're going to see cases where that happens. But we're playing the whole idea of this is playing the odds, putting the odds in our favor. And when the odds are not in our favor, bye-bye. See ya. Who cares? Yeah, you know what? There may be something and we could possibly step in and decide and say, well, let's hold it here. No, but what we're doing in those cases is we're going against the odds. And so when you see me step in, you're going to see me step in cases where something unusual happens that doesn't change the odds, right? We talked about it with J&J when I stepped in and decided to hold it because the stock price was green. That had only happened 3 other times in 600 trades. So it wasn't a case of putting or of risking the odds or saying, hey, the odds are now going to be against us versus for us or anything like that. It was more just staying with the odds rather than letting a little bit of an anomaly bump it out. And so you'll see me step in and do that from time to time, with a market that's ever fluid, that's ever changing. It's not like any sort of algorithm or any sort of recipe or trade system can account for every single variable that may come in. And so that's one of the reasons why this isn't something where, we just set it up on a computer program and boom, run and go. It's not as realistic to do that, especially when we add options because it's just some of the variables that come into play. Now, fortunately, it is put together to where, most of the time I don't have to step in and do anything. If I could, I'd step in and go make a trade right now. I'm itching to, right? Come on. We got a little bit of gain. Let's go. But with no signal, it doesn't put me in a position to be able to do that. So I'll stay patient here with that. Okay. So hopefully that helps to understand that factor a little bit better. And, we can, if you have any other questions on that, simply let me know. Also, feel free to, click here on the video discussion and access that. The shared link for this sheet will be changing here tomorrow. So I will send out the new link here for that you can access, and that'll be in the message feed there on Trader Minute. Thanks for hopping on. Thanks for being with us here at Trader Minute. Have yourselves a fantastic evening, and we'll talk to you tomorrow. Take care.